Hey everyone, and welcome back to the Safe, Simple Sound podcast. I'm your host, Alex, and I'm really excited about today's episode. This one is for all of you out there with a great idea, a growing side hustle, or that dream of finally being your own boss. Today, we're tackling one of the most foundational questions you'll face when you decide to start a small business. What is the right business structure for me? This isn't just paperwork. It's about protecting yourself and setting your new venture up for success. Please note that this content is for educational purposes only and should not be considered personalized financial advice. Always consult with a qualified financial professional before making financial decisions. By the end of this episode, our goal is to give you a sound understanding of your options so you can make a safe and simple choice that's right for you. Ready to build that foundation? Let's get started. We are getting right into the nuts and bolts of turning that brilliant idea of yours into a real, legitimate business. So, you've got the skill, the passion, maybe you've even landed your first few clients. But now you're facing that first big, intimidating question. How do I, set this thing up? This is where we talk about business structure. And I know the term business structure sounds a little dry, maybe even a bit scary. It brings up images of complex legal documents and expensive meetings with lawyers. But I want you to reframe that. Think of choosing your business structure like pouring the foundation for a house. You wouldn't build your dream home on a patch of soft dirt, right? Of course not. You build a solid concrete foundation that can support the weight of your walls, your roof, and everything you plan to build on top of it. Your business structure is that foundation. It's the critical first step that will determine how you're taxed, the kind of paperwork you'll have to manage, and most importantly, how much personal liability you have if things go wrong. Getting this right from the start makes everything else so much easier. So where do we begin? We start at the simplest, most common starting line of them all, the sole proprietorship. Honestly, this is the default setting for American entrepreneurship. The moment you perform a service and get paid for it as an individual, whether you're a freelance writer, a graphic designer, or you're just starting a side hustle selling custom t-shirts, congratulations, you are automatically a sole proprietor in the eyes of the IRS. There's no paperwork to file, no fees to pay. You just are. It's the path of least resistance, which is why it's the go-to for most freelancers and new solo founders. But, and this is a big but, that simplicity comes with a massive trade-off. Let's break it down. The best part of a sole proprietorship is the tax simplicity. The business isn't a separate entity from you. So all of your business income and expenses just get reported on your personal tax return using a form called a Schedule C. Easy enough. Here's the scary part, though. Because the business isn't legally separate from you, you have what's called unlimited personal liability. This is the single biggest risk of this structure. It means if your business gets into debt or is sued, there is no line between your business assets and your personal assets. A creditor or a court could come after your personal savings account, your car, even your home to satisfy a business debt. This is the opposite of personal liability protection. And it's a crucial factor to consider as you think about the choice between a sole proprietorship versus LLC. Now, even with the simple Schedule C, being a sole proprietor means you're taking on new responsibilities for your small business taxes. There are two big ones to know about. First is the self-employment tax. When you work a W-2 job, your employer pays half of your Social Security and Medicare taxes. But when you're self-employed, you're both the employer and the employee, so you have to pay both halves. This is calculated on a form called Schedule SE and can be a bit of a surprise if you're not expecting it. Second, because no one is withholding taxes from your paychecks, the IRS wants you to pay as you go. This means you'll likely need to make quarterly estimated tax payments throughout the year using Form 1040-ES. You can't just wait until next April to settle up. So, let's just pause here for a moment and reflect. I want you to think about this for yourself. First question, what is the biggest fear holding you back when you think about personal liability? And how does the sole proprietorship either calm or amplify that fear? For some, the simplicity is calming. For others, the unlimited risk is a huge red flag. There's no wrong answer. but you need to know where you stand. And one more thought exercise. How can the simple act of opening a separate business bank account, even as a sole proprietor, fundamentally change how you view your business and prepare you for future growth? Think about it. It's not just about clean bookkeeping, it's a mental shift. It's the moment your side hustle starts to feel like a real business. It forces you to treat it with the seriousness it deserves. To wrap this segment up, the sole proprietorship is the automatic, simplest way to start a solo business. It makes tax filing straightforward with a Schedule C, but it leaves your personal assets completely exposed. It's a fantastic starting point, but it may not be the best long-term home for your business. So, here's what I want you to do. Let's make this actionable. Your first action step. Look at your calendar and schedule 30 minutes this week to review your finances and decide if you're ready to open a separate bank account for your business. Don't overthink it. It's the simplest, most powerful way to start building that foundation we talked about. Now, the sole proprietorship is designed for one person flying solo. But what happens when you decide to team up and bring a partner into the mix? That introduces a whole new set of rules and risks. So, what happens when your great idea is too big for one person? What happens when you decide you're stronger together? That's what we're diving into right now. We're exploring what happens when you bring on a co-founder, a friend, or even your spouse. First things first, let's talk about the most common structure for two or more people, the general partnership. This is the business world's version of a handshake deal. If you and a buddy decide to start a web design business and just start doing it without filing any special paperwork, the IRS automatically sees you as a partnership. It's the default. You both agree to contribute your skills, time, or money, and you share in the profits, the losses, and all the responsibilities that come with it. Now, one of the most important concepts to understand with a partnership is something called pass-through taxation. It sounds technical, but the idea is actually pretty simple. Imagine your business is like a clear glass pipe. Money or profit flows through the business and comes out the other end, landing directly in the partner's bank accounts. The business itself, the pipe, doesn't pay income tax. Instead, the partnership files an information return with the IRS, which is Form 1065, basically telling the government, hey, here's how much we made, and here's how we split it up. Then you and your partner each report your share of that profit on your personal tax returns. It's a classic pass-through entity. Sounds good so far, right? Simple enough. But here comes the big, flashing warning sign. With that shared profit comes shared liability. And this is not something to take lightly. In a general partnership, you are both on the hook for all of the business's debts. Let me give you an example. Let's say your partner, in a moment of brilliant optimism, signs a contract for a $10,000 piece of equipment for the business. But then, a client pays late and the business can't cover the bill. That supplier doesn't care whose idea it was. They can legally come after you, personally, for the full $10,000. Not just your half, the entire amount. Your personal savings, your car, it could all be at risk. This is where the trust in a partnership is tested most. And that brings me to a question I want you to really sit with for a moment. If you're considering a business partner, what are the most important what-if scenarios you need to discuss before you even start? I'm talking about the tough stuff. What if you have a major disagreement? What if the business takes on debt? What if one person wants to leave? Having these conversations now, before a single dollar is earned, is one of the most crucial things you can do. Now, for a special group of partners, spouses, the IRS has created a wonderful simplified option. If you and your spouse are running a business together and you're the only two members, you don't have to deal with that complicated Form 1065 partnership return. You can elect to be treated as a qualified joint venture, or QJV. This is a game changer. With a qualified joint venture, you just split the income and expenses down the middle, and each of you files your own Schedule C, just as if you were two separate sole proprietors. It's clean, it's simple, but the biggest benefit goes way beyond just easier tax filing. When you each file a Schedule C, you are both paying into Social Security and Medicare under your own names. You are both building up your own earnings history for retirement. It recognizes the contribution of both spouses in a real, tangible way that impacts your long-term financial security. So, for all the spouses in business together listening to this, here's your reflection question. How does the qualified joint venture provide benefits beyond just tax simplicity? Especially when you think about long-term financial planning and funding two separate individual retirement accounts. It's a powerful tool for financial equality within your partnership. All right, let's wrap this segment up. A general partnership is the automatic structure for two or more people, featuring pass-through taxation, but also carrying significant shared liability risk. And for married couples, the qualified joint venture is a fantastic election that simplifies taxes and ensures both partners get credit for their hard work. This leads directly to our call to action for this segment. If you have a business partner or are considering one, your homework is to research what a basic partnership agreement includes. You can find templates and examples all over the internet. Just understanding the key points like roles, responsibilities, and exit strategies is critical. Outlining expectations in writing now can save your business and your relationship later. Now, that shared liability we just talked about, it's a big deal. For many entrepreneurs, it's a risk they're simply not willing to take. So, what if you want to build a true fortress around your personal assets? A shield that separates you from your business? In our last segment, we talked about partnerships, teaming up with someone to build your dream. It's a fantastic way to grow, but it also doubles your risk because you're often personally on the hook for your partner's decisions. So that brings us to the next level in our business journey. What happens when your side hustle starts making real money? Or when you take on bigger projects, maybe hire your first employee, and the thought of losing your personal savings in a lawsuit keeps you up at night? This is when you stop just building a business and you start building a fortress. And that fortress is called a corporation. This is a huge concept, so let's break it down. The single most important idea to grasp is that a corporation is a distinct legal entity. Think of it like this. You, the business owner, are one person, and the corporation is a completely separate person in the eyes of the law. It can own property, it can sign contracts, and most importantly, it can go into debt all by itself. This is the origin of true personal liability protection. It creates a thick stone wall, a shield, between your business liabilities and your personal assets. If the business can't pay its debts, creditors can go after the business's bank account, but they generally can't come after your family's home, your car, or your retirement savings. That separation is the single biggest reason why people choose to incorporate. But, as with everything in finance, there are trade-offs. The standard default business structure for a corporation is called a C corporation, or C Corp. While it's great for big companies, it has one major challenge for small business owners, and it's a phrase you need to know: double taxation. Imagine your business is a little apple orchard that earns a profit. With a C Corp, the IRS taxes that profit at the corporate level first. That's tax number one. Then, when you, the owner, take some of that profit home as a dividend payment, you have to pay income tax on it again on your personal return. That's tax number two. Your profits get taxed twice before they fully land in your pocket. For a small business, that can be a painful bite out of your hard-earned money. You can find this detailed on IRS forms for small business, like the Form 1120. So you might be thinking, well, that sounds terrible. I want the fortress, but I don't want to pay tax twice. And you are not alone. That's exactly why the S Corporation was created. Now, this is a critical point. An S Corporation, or S Corp, is not a different legal structure. It is a special tax election. You first form a corporation under state law, and then you file a form with the IRS saying, hey, I'd like to be taxed as an S Corp, please. What this does is magical. It keeps the strong liability shield of the corporation, but it completely eliminates the double taxation problem. An S Corp is a pass-through entity, just like the partnership we talked about earlier. The profits pass through the business directly to the shareholders, and you only pay tax on them once on your personal return using a form called the 1120S. You get the protection of a fortress with a more favorable tax treatment. It's the best of both worlds, right? Well, almost. That protection and tax advantage comes with a price, and that price is complexity and cost. Running a corporation, even an S Corp, means you have to play by a stricter set of rules. You need a board of directors, you have to hold formal meetings, even if it's just you in a room with a notepad, and you have to keep detailed records called minutes. The line between you and your business has to be crystal clear. This brings up a really important question you have to ask yourself. At what point in your business journey does the peace of mind from liability protection outweigh the cost and complexity of forming and maintaining a corporation? And while the S Corp sounds amazing for avoiding double taxation, a lot of new entrepreneurs don't anticipate the new administrative burdens that come with it. The big one? Payroll. As an owner of an S Corp, the IRS requires you to pay yourself a reasonable salary. That means you're not just taking money out of the business anymore, you are officially an employee of your own company. You have to run payroll, withhold taxes, and file payroll reports. It's a significant step up in administrative work. So, let's recap. A corporation builds a powerful fortress of personal liability protection around your assets. The standard C Corp often leads to double taxation, which is tough for small businesses. The S Corp election solves that by becoming a pass-through entity, but it demands more formal rules, more paperwork, and often the new headache of running payroll. So how much does this fortress actually cost to build? To make this less of an abstract idea, here's your action step for this segment. Sometime this week, go to your Secretary of State's website. Just search for Secretary of State Business Services. Find the section on business formation and look up the filing fees for creating a corporation. Is it $100? $500? Seeing that real-world number in your state makes this decision much more concrete and helps you weigh the true cost of that peace of mind. In our last segment, we climbed the mountain of complexity and talked all about corporations, the C Corp and the S Corp. We covered that rock-solid personal liability protection, but we also talked about the formal meetings, the stricter rules, and the potential for double taxation. For a lot of new entrepreneurs, it can feel like a bit too much, a bit too soon. But what if you could get that corporate-style liability shield without all the corporate-level hassle? What if there was a structure designed for the modern small business owner? Well, there is. And today, we're doing a deep dive into the most popular choice for new businesses today, the flexible hybrid known as the limited liability company, or LLC. And stick around because at the end, we're going to pull everything together in a final summary to help you make your choice. So, what exactly is an LLC? I want you to think of it as the greatest hits album of business structures. It was specifically created to take the best features from the other structures and combine them into one flexible package. First and foremost, the LLC offers the number one thing people seek from a corporation: personal liability protection. The name says it all: limited liability. This means that if your business incurs debt or faces a lawsuit, your personal assets, your house, your car, your savings are generally protected. It creates that crucial legal wall between your business life and your personal life, which is a huge source of peace of mind. But here's the magic. It combines that protection with the simplicity and tax flexibility of a sole proprietorship or a partnership. You get the shield without having to act like a massive corporation. This is truly the best of both worlds. Now, this is where the LLC really shines, and frankly, where some confusion can pop up. Let's talk about how it handles small business taxes. The LLC is a tax chameleon. It changes its colors to fit its environment. Here's what I mean. The IRS doesn't actually have a separate tax classification for an LLC. Instead, it looks at your LLC and taxes it as something else by default. If you are a solo business owner and you form a single-member LLC, the IRS just disregards the LLC for tax purposes and treats you exactly like a sole proprietorship. You'll report all your business income and expenses on a Schedule C right on your personal tax return. Simple, straightforward, no new complicated forms to learn. If you and a partner form a multi-member LLC, the IRS defaults to treating you like a partnership. Your LLC will file an informational return, and the profits will pass through to you and your partner to report on your personal returns. Again, you're using a system we've already discussed. The key takeaway here is that the LLC gives you that corporate liability shield, while often keeping your tax situation as simple as it was before. But Wait, there's more. The LLC has a superpower, a secret weapon that becomes incredibly valuable as your business grows. An LLC has the ability to choose how it's taxed. Once your business is generating a healthy, consistent profit, your LLC can file an election with the IRS to be taxed as an S corporation. Now, why on earth would you do that? In a word, taxes, specifically self-employment tax. By making the S corp election, you can pay yourself a reasonable salary and then take any remaining profits as a distribution. You only pay self-employment taxes on the salary part, not on the distributions. For a successful business, this strategy can lead to thousands of dollars in tax savings each year. This is the ultimate example of the LLC's flexibility. It grows with you. It starts simple, and then it gives you powerful tools to use when you need them. Okay, we've covered a lot of ground over these last few segments: the sole proprietorship, the partnership, the S Corp, and now the LLC. Let's put it all together in a final, clear comparison. Think about it like this. If your absolute top priority is ease and cost of setup, and you're just starting out or testing an idea, the sole proprietorship is your go-to. It's instant and free, but you carry all the liability risk. If you want liability protection above all else, but also need tax flexibility, the LLC is almost always the answer. It's the perfect middle ground. If your business is established, profitable, and you're looking for the most advanced way to optimize your taxes and save on self-employment tax, then forming an LLC and electing to be taxed as an S Corp is that next-level strategy. It's more complex, but the savings can be significant. This brings us to a really important moment of reflection for you. I want you to ask yourself two things. First, given how great the LLC sounds, what are the most compelling reasons you might still choose the simplicity of a sole proprietorship to start? Maybe it's the filing fee in your state, or maybe you just want to see if your side hustle has legs before you formalize anything. There's no wrong answer, but you need to know your why. And the second, bigger question: what one factor is going to be your North Star in this decision? Is it your projected annual profit? Is it the risk level of your industry? Say you're a consultant versus a construction contractor. Or is it your plan to hire employees in the near future? Zero in on your most important factor, and the right choice will become much clearer. To help you do just that, here is your call to action for today. I want you to actually do this. Grab a piece of paper or open a new note on your phone. Create a simple chart with two columns. On the left, label it My Business Needs. On the right, Best Structure Fit. In that left column, I want you to list your top 3 priorities right now. Is it maximum liability protection? Is it the absolute lowest cost to get started? Or is it tax simplicity? Be honest with yourself. Then, in the right column, map those needs to the business structure we've discussed that best fits. This simple exercise will move you from thinking to doing, and it will give you the clarity you need to take that next big step with confidence. You can reach out to us at safesimple.sound.com if you personalize consultation based on your situation. Choosing your business structure is one of the most important foundational decisions you'll make. By understanding these core differences, you're no longer just guessing. You're building your business on solid ground. And that brings us to the end of our deep dive into the world of business structures. We covered a lot of ground today, but I hope it feels much clearer now. We started with the simple default path of the sole proprietorship, weighing its ease against that critical issue of personal liability. We talked about teaming up in a partnership and the great tax option for spouses. Then we built a fortress with corporations, understanding that the S Corp is a powerful tool to avoid double taxation. And finally, we explored the modern, flexible LLC, that financial chameleon we talked about at the start. For so many of you just figuring out how to start a small business, that LLC versus sole proprietorship question is the big one. And now you see why. It's the classic battle between ultimate simplicity and essential protection. Making the right choice for your business structure is one of the first and most important ways you can get a handle on your small business taxes and protect your personal assets. I hope the key takeaway is that this choice is all about aligning the structure with your specific needs and goals. Remember those action steps. Schedule that 30 minutes to review your finances, research a partnership agreement, or check your Secretary of State's website for fees. It's about making this real. You'll find links and resources for all of these in our show notes. Thank you so much for tuning in and being part of the Safe, Simple Sound community. If this episode helped you, the biggest compliment you can give is to share it with another aspiring founder who might be feeling a bit overwhelmed by all this. And of course, please subscribe so you don't miss what's coming next. Remember, this is all about seizing financial control and creating that financial safety net from day one. It's your dream, and you're building it on a solid foundation. This is Alex, your host, signing off. Until next time, stay safe and keep it simple.